To a 36th new record yesterday. Will it be 37 today? Less than 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Another day, another record for Wall Street. The S&P 500 on its longest winning streak since January.
And Jay Powell may power the rally even further. The Fed chair returns to Capitol Hill for day 2 of his testimony.
And risks remain to the rally as investors brace for key inflation data and the start of earnings season. So let's take a look at where markets are trading right now. 30 minutes to go until those bells ring. You can see we are building on yesterday's momentum. The S&P 500 currently up about 0.2% in the pre-market. Even better if you take a look at big tech, currently up about 0.4% on the Nasdaq 100. A little bit of a rally building in the bond market. That 10-year yield back below 430, currently down about 2 basis points, Matt.
So it's a big bet on tech revenue growth, also on bad economic news. You can see here this blue line represents economic surprises, and they're mostly to the downside of late. That has helped power the rally and valuations up to 22 times forward earnings as investors expect a cut.
And Matt, there are some stocks to watch before the market opens. Of course, I'm watching shares of Apple gaining after reporting a 21% gain in PC shipments last quarter. That was the biggest jump among all global PC makers. According to a report by IDC, Apple up about 0.4% pre-market. Also, Air Products and Chemicals watching it surge almost 2% this morning, higher after Honeywell announced that they're buying the company's LNG process technology and equipment business for $1.8 billion in all cash.
Joining us now is Lori Heinel, Chief Investment Officer at State Street Global Advisors. And Lori, we continue to hit record after record, even with economic surprises disappointing, even with, rate cuts. We thought at the beginning of the year we'd see 5 or 6. Now it's like 1 or 2. What do you think continues to drive us higher?
Well, there are several things that will drive us higher. First of all, it's continued optimism about some of these long-term thematics like AI and digitization. And we're going to probably continue to see that as these companies have a lot of momentum in their sales activities and continue to kind of divine that future. But we're also seeing less concern about a recession, and that's going to help areas like banking. It actually should help some of the consumer discretionary areas. And so you're seeing a broadening out in the marketplace.
And let's follow that AI story because we had Citi out with a report earlier this week saying it's basically time to take some profit in the high flyers of this cycle. Then you have BlackRock, who is still both feet into that AI theme. When do we see the AI rally start to broaden out? And is that the time to really follow it into something other than just the chip makers, for example?
Well, I think one of the keys is going to be, when is there something else that looks attractive that gets confidence, and then you actually have investors starting to chase those areas as well. So we do think that there are opportunities in materials and industrials. We do think that there are opportunities in some of these consumer discretionary areas, obviously select IT. So right now, people aren't concerned about the stretch valuations, but once you start to have other opportunities build, as we do navigate this soft landing, we think that there will be more vulnerability in some of those high-flying names.
Now, if you're worried about the high-flying names, Lori, how do you feel about some of the things that are starting to broaden out? I thought what you said was pretty interesting about the banks and consumer-focused stocks, given there is still a lot of concern around those names, and many of those names are going to start reporting as early as tomorrow.
Mm-hmm. Well, first of all, we don't think there's any immediate concern. In fact, if anything, there actually are a lot of bright spots because we have continued to have strong economic activity. And we're starting to see that broaden globally. So if you look at our tactical allocation portfolios, for example, we've started to spread our equity bets a bit. So earlier this year, it was definitely more focused on U.S. large cap. But now we're looking at areas like Europe, where we think that valuations are relatively attractive. So we think trying to diversify your portfolio here so that you're not over-geared to those high-flying names, but you're also ready for opportunities as this market does start to broaden out.
What do you think about the leadership? I mean, are we going to see any changes, Lori, as we get deeper into earnings season? I know that Gina Martin Adams from Bloomberg Intelligence is writing that, the Mag 7 earnings growth is going to slow down. And for the first time in like 7 quarters, the S&P 493, the other stocks in the index, are going to show expansion.
Well, we've been waiting for this moment for a while. And as you think about what's happening right now, inflationary pressures are starting to abate. So that may support certain industries. You probably see consumers slowing across the board, but very much pockets of strength still there. The banks will be an interesting one to watch because they may actually be able to release some of their reserves and things of that nature. There are still vulnerabilities in things like the commercial sector. So I think it's going to be a much more idiosyncratic market. You're going to have to look industry by industry and company by company as we broaden this market out.
And of course, we're waiting for the unofficial start of earnings season, which is, of course, the big banks kicking off at the end of this week. We have had some earnings come through. Helen of Troy, for example, results really disappointing there. A bit of a worrisome sign about the consumer.
Big downgrade this morning.
Exactly, that too as well. So you think about the state of the consumer, the softening consumer. You say that it's going to be an idiosyncratic earnings season, but how much of a common denominator is that weakening consumer in these reports that we're expecting?
Well, it's likely to be pretty bifurcated. We're already seeing that, right? If you look at the upper echelons, they still have the wealth effect. They're seeing their equity portfolios grow. They're seeing their housing values grow. They're not vulnerable in terms of employment at this stage in time. So they're actually in a pretty good spot. But as you note, if you look at the other end of the spectrum, there are vulnerabilities. The savings rates are going lower. You're starting to see some consumer delinquencies. Wage growth is not improving. So it really is going to be a tale of two cities. And that's why we're very much focused on discriminating and quality, looking at those quality balance sheets, those companies that have a bit of a moat and are geared to those places that are still growing.
How much conviction, Laura, do you have to put money to work at these levels? You're looking at potentially a 37th day of record highs in the S&P 500, and you have to wonder whether it's equities, cash, gold, fixed income. How do you think about allocation overall?
I'd say the first thing is we are still overweight equities, but we're also holding a fair amount of cash to be opportunistic if we do see a pullback. And as you know, we also are holding some gold because we think that that's one of the few diversifiers against some of the extreme events that we may see over the coming weeks and months. But I think it's important to note that within our equity portfolios, we are diversifying a lot more. We're not focused just on the Mag 7. We're not focused just on U.S. large cap growth anymore. It is a more broadening story.
Wait, when you say gold, you mean the actual soft metal or Bitcoin?
Well, the original crypto, I like to say, gold, the original crypto.
Not diversifying into, I mean, it's pretty amazing to see Bitcoin still holding. I think it's up again another 1% and change today to $59,000. Is that not an asset that you think is, important to hold in a portfolio yet?
Well, look, when we look at strategic allocation and tactical allocation, we tend to focus on those asset classes that have a little bit longer history, that have more stable correlations, where you actually can think about, analyzing them going back further. But look, there are opportunities. If you want to think about speculative opportunities, there are opportunities in all sorts of other assets, and crypto would be one of those. But size your position appropriately, recognize that it's going to have a lot of volatility.
All right, Laura, you're going to stay with us. We have more to talk about with you as Jay Powell goes in front of the House today. So Lori Heinel of State Street Global Advisors sticks with us after our 36th record high on stocks. Here you can see futures. So right now, S&P futures up 0.25%. If it holds, or if we trade in the green by the end of the session, it'll be a 37th record high. And we're only in the middle of July. It is, though, a very solid month historically for stocks. Coming up, day 2 of Jerome Powell's testimony. We'll preview what to expect from the Fed chair next. This is Bloomberg. Let's get to high interest now. A look at what's making headlines around the world. Joe Biden's allies are trying to shift the narrative from the president's mental acuity to Donald Trump's policy goals. Many Democrats are warning of the dangers of Project 2025, which is a suite of policy proposals drafted not actually by Donald Trump, but by the Conservative Heritage Foundation for Trump to pursue if he's elected in November. The proposals range from gutting the federal civil service to blocking efforts to fight climate change. And Trump is getting closer to announcing his VP pick. During a rally in Miami, Trump teased the possibility of Florida Senator Marco Rubio, previously known as Little Marco, as his running mate. He stopped short of making an official announcement, but did say he was officially challenging President Biden to another debate, this time without moderators. NATO allies promised 5 long-range air defense systems for Ukraine in a fresh show of support. The treaty organization's leaders resisted offering the country a path toward membership, and fresh assessments indicate the conflict with Russia is headed towards, as you may have expected, an indefinite stalemate. Katie?
And also of high interest today is day 2 of Powell's testimony on Capitol Hill. Speaking today before the House Financial Services Committee, Bloomberg's Mckee joins us now for a preview. And Powell really didn't want to say anything about the timing of policy moves yesterday, but what did we learn from the Fed chair?
Well, there was a shift in tone or emphasis from Jay Powell yesterday towards the idea that the risks are balanced now between inflation and growth/unemployment. The Fed watching the growth figures come down. The Atlanta Fed GDP now number now down to about 1.5%, unemployment up to 4.1%, where they thought it would be at the end of the year. So the trends are towards a slowing economy. Now, July is too soon, but they could be setting up, if they get good news tomorrow with CPI at the end of the month, if they get good news from the PCE, and that continues, they could be setting up for September. But because they don't know what they're going to get in these data releases yet, Powell is unlikely to give us any kind of firm indication. The markets are just reading between the lines.
Mckee, we thank you so much for your analysis, keeping an eye on all of it, of course, in day 2 now of Powell's testimony to Congress. But for now, still with us, Lori Heinel, Chief Investment Officer at State Street Global Advisors. And you hear what Mike was telling us, this idea about more balanced risks between inflation and growth. But as an investor, what are you more concerned about, inflation or growth?
Well, look, we're concerned about both, and they're both intertwined. But we do think that the Fed needs to cut more rapidly than perhaps Powell is admitting at this stage in time. This idea of data dependence, while it's important, we see a lot of variability in the data, a lot of revisions in the data. And so I think what we saw in the testimony was recognition that those risks are more balanced, and the labor market is cooling a bit. And we hope that that will give them the cover that they need to cut rates, ideally by September.
Well, Lori, to that point, you were out with a big call in April that you expected the Fed to cut rates in June. That didn't materialize. It seems like most people in the market are coalescing around September.
50 basis points, right?
50 basis points was the June call for Lori there. But why do you think the Fed needs to cut rates here? Because there's plenty of people that we talk to on this program and others that say the Fed has the luxury of being able to wait right now.
Well, look, we know that policy operates with a lag. And so if we look at the backdrop right now, we've got an economy that's going to grow at around 2% or so. We've got inflation that by the Fed's own measure is now below 3%. We don't think there's anything magical about the 2% number per se. In fact, not that long ago, the Fed was talking about a range around 2%. So this obsession with getting inflation durably below that target of 2%, we think is making the economy quite vulnerable. Rates at 5.25% to 5.5% just aren't consistent with an economy that's slowing at the levels that we see.
Well, let's talk about why it makes the economy vulnerable and why it might make the stock market vulnerable. Because you take a look at where we're sitting with rates at 5% or so, and it feels like you haven't seen sort of that higher rate environment play out in ways you might have expected in previous cycles. So what do you see as the risk of the Fed waiting too long to lower rates here?
Well, there are several things that have helped during this environment. Certainly one of the big ones is that their higher rates haven't bit into consumers as much as one might have thought. And that is for a variety of reasons. The overhang of some of the stimulus that the consumers had, a little bit of wage growth and strong employment. And if you look at housing, for example, the bite just isn't there because you haven't had the turnover in housing that would reset the levels of rates in housing markets, for example. But it's also in businesses where they're not necessarily vulnerable. They have strong balance sheets. A lot of the refinancing risk is still sort of pushed out. But that doesn't mean that doesn't create problems, because ultimately you do need to have good financing to grow. You do need to have attractive rates, et cetera.
It's pretty amazing. In fact, Torsten Slok was on this yesterday, and he pointed out that pre-pandemic, 38% of homeowners had a mortgage under 4%. Now it's 63% of homeowners that have a mortgage under 4%. So that reduces kind of the power of monetary policy, if you will. do you think Jerome Powell needs to make bigger moves to fight that kind of drag? I mean, is that why 50 basis points he should be thinking about, in your view, rather than 25?
Well, our view is that he does need to act soon, and he should act with some intensity. So 50 basis points in September would be very attractive from our vantage point, and we think probably another rate cut before the end of the year. Because again, policy operates with a lag. If you're only doing 25 basis points each time, how long is it going to take you to get the rate from 5.25 down to 3.25, or perhaps even lower? Every day, if you will, that goes by, or every Fed meeting that goes by where no action is taken, that creates more vulnerability that we don't achieve the soft landing, that we actually have something more nefarious.
So, and he, yesterday he was saying, yes, inflation is coming down, and they're confident about that. He also mentioned that the labor market is softening. And if you look at economic surprises, I know I harp on this, but if you type ECSU go on the Bloomberg, you can see that we just continue to disappoint in terms of the economy. Do they risk a recession if they don't cut, a little bit further, a little bit faster?
We think that they do. And again, there's a lot of enthusiasm about some of the long-term opportunities, right? And we talked a little bit about digitization and other AI and other areas. But in the moment, if you will, consumers are starting to be vulnerable, particularly at the low end. The higher rates are starting to bite, and the longer that we maintain an imbalance between growth and inflation and those restrictive policy rates, the more likely we do have a recession.
Lori, let's talk about the potential for that September rate cut as the market is expecting. And you think about all that cash that is on the sidelines. You think about all the money in money market funds and the rotation you may or may not see. How do you think that cut will cause any repositioning? And do you think that repositioning may perhaps be already priced in?
So we think there's a slow repositioning already happening, and we are seeing more demand for longer durated fixed income, particularly some of the sectors like investment grade credit, where there's an incremental yield beyond just treasury rates. And we don't think this is going to be a tsunami, because even if the Fed does cut by 50 basis points, you're still going to see money rates that are 4 handle, maybe even a low 5 handle. So it's not going to be a quick change, but we do think that there is valuation in rates right now. We do see that there's volatility there, so it may take a little while to realize that duration bet, but that would be one of our favorite trades for the back half of the year.
And if you don't get that September cut, you kind of made this warning call here that every day that goes by without a cut and that rates stay high, it creates a greater risk of a greater downturn. How much room does the Fed really have, in your view, before causing something greater in terms of a downturn?
Well, they have some wiggle room here, but the big thing would be that they'd have to respond more rapidly and more intensely if they keep delaying. So there also is this trade-off where if they don't move in September, and then you start to get into closer to the election period, and again, the Fed's not a political animal, but by the same token, they're going to be watching what they do very carefully. Then all of a sudden, you might have a very sharp fall off in economic activity or a sharp increase in unemployment rates. And then they've got to act a lot more responsibly. And will they be willing to do that?
Lori, it is so great to speak to you. Really appreciate you joining us on our launch week. That, of course, is Lori Heinel of State Street Global Advisors. It's so interesting to speak to Lori. Of course, we spoke to Torsten Slok yesterday. His big call was that the Fed doesn't cut rates at all in 2024. She obviously on the other side of that, saying that the Fed should have cut in June and they should cut right now.
Well, part of that view, too, from Torsten was this idea that they have that wiggle room, that things are still really strong out there. Yardeni seems to take this similar type of view, that things have not really broken to the degree you thought they would with a hiking cycle that has not only been so fast, but lasted so long.
On the other hand, depending on who wins in November, right, we've heard Larry Summers say that Trump's policies are the most inflationary he's ever seen. And, if Donald Trump is elected and puts those policies in place, I know, those are some big ifs. Jerome Powell may not really have time to fight that, and he may have to go the other way. Or
he might be too soon, exactly.
A delicate dance for the Fed chair. Of course, we'll be hearing from him in the next hour or so. But coming up on this program, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers, the companies making the most waves on social media this morning. And first up, Microsoft and Apple are dropping plans to take board roles at OpenAI. Now, this surprise decision underscores the growing regulatory scrutiny of big tech's influence over artificial intelligence. Big U.S. tech companies like NVIDIA, Alphabet, and Amazon have poured tens of billions of dollars into AI businesses. Next up, we have LegalZoom not passing the bar. The online law services company cutting its full-year revenue guidance below estimates and also announcing a sudden CEO change. Now, that news spurred at least 3 analyst downgrades, and you can see that in the stock, down almost 31%. And finally, the discount chain Big Lots saying today it will close up to 40 stores this year and may declare bankruptcy. The company blames inflation and decreases in consumer spending. And you've also seen other brick and mortar chains such as Rite Aid and Red Lobster also announcing closures this year. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. So interesting to see more bankruptcies, more potential bankruptcies here. Of course, Red Lobster shrimping themselves to death. That was a big story a couple months ago, and we'll see.
Is that really what happened? Did they offer like never-ending shrimp, and that drove them to bankruptcy?
They did lose money on it, but probably not enough that would explain completely the bankruptcy. You know what they
say about good intentions, right? Not all of them always work out so well. You know, actually, U.S. bankruptcies, according to S&P Global, reaching the highest monthly level since the early pandemic.
That is a cool function, by the way. BCY Go on the terminal allows you to break down bankruptcies into industry groups.
But you can also see where a lot of the pain is. Consumer discretionary, almost a fourth here of this year's bankruptcies. Healthcare, real estate also starting to stack up. Technology starting to rise as well. Remember, that is where a lot of those unprofitable companies are, and the capital markets has started to close to them. So a lot of ripple effects, and it really speaks to that dispersion investors are talking about.
If I could quibble, I would say that maybe the chart shouldn't be green. That makes it look like
it's doing super well. It should definitely be red.
It's good for the bankers and the lawyers. You know how expensive a bankruptcy is?
That's true. That's true. Someone does end up benefiting from that.
You can go into detail here on this function and see Mallinckrodt, Odyssey, Enviva, Yellow Corp. I remember that one. Joanne. All of these with, 2, 3, 4, 5 billion in liabilities.
Bad for consumer options, by the way, at the end of the day.
All right, very interesting stuff on bankruptcies. It hasn't stopped us from hitting new records. Of course, it's really this rally been powered by 7, 10. Some have even said, Wilson says 50 stocks, right? His nifty 50. And we continue to see futures rise into the open. Just got less than 4 minutes left, and we're up on the S&P a 0.25%. We could have a 37th new record today. This is Bloomberg. All right, less than 30 seconds until the start of trading after another record high for the S&P yesterday. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures pointing higher again today ahead of Powell's testimony on the New York Stock Exchange. Ringing the bell, we have Spectrum 360. That's a nonprofit that helps education for people with autism and related disorders. The New York Stock Exchange has always been a big supporter of autism. And Talon Energy starting to trade on the NASDAQ. Let's get over to Katie Greifeld right now. She's got a check on the major averages.
Yeah, you take a look at how the big indexes are trading as the bell rings. It's another update for the S&P 500, up about 0.3%. This would be number 37 for record highs so far this year. Take a look at the NASDAQ 100, up about 0.4%. We put the Dow Jones just for you, Matt Miller, and it's doing absolutely nothing. I'm going to go ahead and call that
39,000.
I'm not that excited. Let's talk about single stocks here, because Air Products and Chemicals, it's gaining. This after Honeywell agreed to buy its LNG process technology and equipment business. It's a $1.8 billion all-cash transaction. Not seeing a lot of movements in the stocks as you might have expected, but still, Sonali, still really interesting to see a deal in this market.
Absolutely. M&A driving markets as well as leadership changes. Keeping an eye now on 3M. The company announced that its CFO is stepping down at the end of the month. You may remember here, Katie, that at 3M, they also had a CEO change earlier this year. 3M now up actually about 1% on the day. People seeing it as a sign now that perhaps a new CEO could put one of his own in place.
All right, NVIDIA also climbing higher today alongside other chip makers and AI-related stocks after TSMC. Let's get a closer look at Bloomberg's Abigail Doolittle. Abby, what do you got?
Yeah, well, Taiwan Semiconductor put up a great quarter, 40% sales growth. And as a result, you can see those ADRs up about 2%. But to your point, NVIDIA up nearly as much. And this has a lot to do with the fact that Taiwan Semiconductor is the sole provider of NVIDIA's most advanced chips, Apple's too, as a matter of fact. And when I use the SPLC, or the supply chain function in the Bloomberg terminal, TSMC is about 10% of their revenue or so comes from Taiwan, from NVIDIA, 25% from Apple. But that's why some of that strength is here. But we all know about the NVIDIA rally. But let's put it into perspective, because one question everybody has, can it last? And you can see over the last year, up 215%, the stocks up 59%, and then the S&P 500, not shabby, 25%. But that equal weighted index up 8%. So again, can this last? One thing I would like to point out, Katie, is while their revenue growth is really robust, if we take a look at what's expected ahead in the last quarter, the fiscal quarter ending in January, up 126%. This current year that ends in January of 25, almost 100%. But then take a look at this, really a slowdown as investors start to focus on that. Unless they continue to boost, well, the shares may come back to earth.
And that, of course, would be bad news for the broader market, given it feels like the entire stock market rests on NVIDIA's shoulders. Abigail Doolittle, thank you so much. Joining us now is David Lefkowitz. He is UBS Global Wealth Head of U.S. Equities. And let's talk about your year-end price target, 5,500. The S&P 500, it's just below 5,600. Your upside target is 5,700. We're not too far away. Tell us about the path there between now and the end of the year.
Sure. Yeah, Katie. I mean, yeah, obviously the market has had a very good year so far, and we're just barely over halfway done. But look, I would say the broader picture is that the environment remains pretty supportive, right? We've got pretty good growth, pretty durable growth. We're seeing a reacceleration in profit growth. I think as we go into the second quarter earnings season, we're probably going to see the fastest profit growth in more than 2 years, and a broadening out of that profit growth. At the same time, we've got inflation coming down, and it looks pretty likely that the Fed is going to start cutting interest rates. We think we'll get 2 interest rate cuts this year. And then you guys were just talking about all the AI developments, and clearly that's been a major positive driver for the market. So it's a positive backdrop. I would say it is tricky though, because so many of the market gains, so much of the market gains have been driven by such a small number of stocks in the marketplace. That makes it tricky, but in general, we think it's a positive environment.
You know, we're going to talk with Jessica Menton from Bloomberg News in a moment about earnings season, and you mentioned the broadening out. Gina Martin-Adams from Bloomberg Intelligence wrote a note about that broadening out. We're going to see the first expansion for the S&P 493 in 7 quarters. But for the Mag 7, David, it looks like the incredible sort of explosive growth they've had. Earnings, I think, for the Mag 7 were up almost 60% in Q4 of last year, is going to continue to slow down. Does that concern you?
Yeah, I'm not too concerned about that, Matt. I think what investors are going to care about is, are those estimates do they get beat or missed? And we think the trends in terms of AI, especially, are still quite robust. I mean, we just saw the Taiwan Semi news. Companies are scrambling in order to put together the applications, make sure they have the investments in place to get their organizations ready for trying to adopt artificial intelligence, and we think those trends remain in place. So, yes, revenue growth, earnings growth is slowing down for the Mag 7. It's still at a very robust pace, and it probably will remain faster than the 493 through the end of this year. As we get into next year, that's more difficult to assess at this point. But I think the key point is that will those numbers be beaten or will they be missed? We think there's still very good support for the Mag 7.
Well, another thing about this, too, even if you believe that the high flyers here have room to run, what about the rest of the AI universe? Do you believe that it's better to keep your chips on the table with the safest, biggest names that everyone has been flocking to? Momentum has been a big part of this market. Or do you start to look for some of the undervalued ones, the unloved ones so far, David?
Yeah, look, I think in terms of technology adoption curves, I do think history suggests you do want to stick with the leaders. That the market, I think, has been very efficient about identifying which companies have the special sauce, which companies have the advantages that will prove beneficial as we adopt these new technologies. Now, obviously, that can change over time, and we're very attuned to that. And we still have a lot of questions around who will be the winners in terms of the applications that are ultimately developed, and frankly, will they come in time? I mean, that's in time to justify some of these valuations. These are all important questions. But right now, what's happening is that we're building out the infrastructure, and it's clear who has the leadership roles there. And we would say stick with those. Yeah, there certainly are some ancillary companies that also stand to benefit. But the core of the portfolio within the AI complex should really be the leaders in the marketplace that have those moats around their businesses.
And it's a good point, too, that maybe when it comes to some of the users of AI, the applications, it's too early to pick winners there. Let's talk about something other than big tech. I know it's very hard in this market, but I'm looking through your notes. I see you also are positive when it comes to the industrial sector. What's the bull case there for some of the names in that group?
Yeah, so I mean, obviously we're building diversified portfolio. So tech is an element of it, but industrials we think is also kind of interesting here, especially because it's lagged quite a bit. It's a very heterogeneous sector, but there are a couple of segments that we think are interesting. First of all, if you look at transports, these are primarily the railroads, the parcel guys. We've been in a freight recession for some time now. We think we're nearing the end of that. A lot of the companies are executing on self-help measures, reducing costs, things like that. And we think that will start to bear some fruit. You look at the aerospace cycle. It's been hard for airlines to get new airplanes. So we're running the existing fleet harder. That means the aftermarket in aerospace is likely going to remain pretty robust. You've got the infrastructure leverage companies in there as well. There are maybe some risks around if there's a new administration. There are some companies leveraged to the Inflation Reduction Act and the green subsidies and things like that. But we think there's enough diversification. And I would say the last point here is that the ISM Manufacturing Index has been depressed for quite a long time now. Inventories are pretty clean, and we think it could be just a matter of time before we start to see a more persistent improvement in the ISM manufacturing, just the global manufacturing cycle. So, I think there's a number of positives in the industrial sector, but it is a pretty diverse and diversified sector.
Another part of this I want to talk about, too, is the financials. I want to shift right over there because, of course, we have the banks starting to report this weekend, but also a ton of divergence in how investors are viewing the opportunity in financials, particularly if you have an interest rate cut priced in September. David, who wins in that scenario?
Yeah, so I think there are some cross currents in financials. First of all, I think we also have to acknowledge that if there is a Trump victory or Republican victory in November, financials probably are one of the better sectors or one of the best positioned sectors because we'll probably get some deregulation. You'll probably get a little bit less focus on antitrust enforcement, which has been pretty stringent under the Biden administration. That'd be good for merger and acquisition activity, which a lot of the capital markets levered companies would benefit from. So, that is a potential positive. And you're right, Sonali, as we get into Fed rate cuts, cost of funding could start to improve. And so, we're not making distinctions within the financial sector, but I would say from my perspective, there is potentially sort of an asymmetric opportunity here. If Biden and the Democrats stay in office, there's probably not much downside. But if Trump does enter office, you probably get upside from some of those items I was talking about.
David, I want to show a seasonality chart on the Bloomberg terminal. I'm sure you've used this function, but if I look at the S&P 500 and type SEAG Go, I can track how well the index has done over the 12 months of the year. I've looked at back 20 years. July is the best month. And I bring this up because Sonali asked if you keep your chips on the table, right? Is this a good time, considering that August is a bad month, September is a bad month historically? Is this a good time to take some profits? I mean, after this 17% rally on the S&P, can we expect a little bit of a correction here?
I was just running some numbers yesterday. We haven't had a 2% down day since February of 2023. So yeah, it's been a remarkably slow and steady grind higher, and a pretty rapid ascent for some companies. But look, I would say, Matt, it still is a pretty favorable environment for all the reasons that we talked about, with the earnings, with the inflation improving, with the Fed now moving into a more dovish stance, which seems pretty likely. So I do think you want to stay invested. And for our clients, we're building long-term portfolios, right? So we're not going to be too concerned about whether there could be a small sell-off, which is certainly possible, especially as we get into election uncertainty and things like that. But I would focus on the bigger picture here, that the environment is still quite favorable, even though the market has been quite strong this year.
Got it. David, great getting you on our inaugural week. Really appreciate you joining us on Open Interest. David Lefkowitz there of UBS Global Wealth. Coming up, earnings season kicks off and growth may expand beyond the Magnificent Seven for the first time in 7 quarters. We'll discuss the companies to watch next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Goldman Sachs raising its target on Tesla to $248 after the EV maker reported better than expected second quarter deliveries. The analyst also cites reduced inventories levels and new IRA credit eligibility on some U.S. models. Next up, we have Needham upgrading Carvana to a buy with a street high price target of $160. The firm says that the online used car retailer has a profitable growth outlook. Now, the stock has climbed nearly 140% year to date, up another 7% or so today. And finally, we have Bank of America cutting its recommendation on Visa. The analyst giving Visa a neutral rating, saying that there's limited upside to its valuation. The firm also downgrading MasterCard, definitely something to keep an eye on as those big banks kick off earnings season this Friday.
Yeah, that is interesting. I mean, especially as we see that consumers are putting more debt on plastic than ever before, right? I don't know the exact number, but it's something like more than $17 trillion in credit card debt for U.S. consumers.
And you had the New York Fed consumer survey really just come out this week. Everyone is pointing just that out. And you have, for example, Bank of America now pointing out both Visa and MasterCard. Remember, these are two stocks last year, Matt, that were up more than 20%. Visa was up 25% last year. This is a question of whether they can really squeeze out more top line growth when the consumer is already so maxed. And
their hunch, by the way, I mean, that's the intraday, right? But if you look year to date,
Visa's not doing anything.
No, zero year to date. So really interesting stuff. All right, speaking of earnings, we're going to get a fresh read on the consumer tomorrow. I should say, speaking of the consumer, we're going to get fresh earnings tomorrow when Delta and Pepsi report. Analysts now focused on the S&P 500 stocks that aren't in the Magnificent Seven. Specifically, analysts at Bloomberg Intelligence, right? Gina Martin Adams wrote a great piece about it today. You can see it typing BIGO. We've got Jess Menton here on set. She's our senior equities reporter for Bloomberg News. And the thing that caught my eye about GMA's report is she says the 493 are going to start growing their earnings for the first time in 7 quarters. I didn't realize there'd been a contraction that's lasted so long.
That's right, because we had a 3-quarter contraction that ended in the 3rd quarter of last year. But during that time, overall for the index, that's correct. And then since then, big tech, not surprisingly, has been carrying that. If you look at this last quarter, still about 50% growth year over year. But the narrowing's happening because if you think of the base effects for big tech compared to, say, there was a bear market, the earnings outlook wasn't as strong in 2022. Then a little over a year ago, NVIDIA obviously had that gangbuster revenue forecast. So that if you're comparing now to then, it's just not as extreme. But the point is when you're looking at more of these, say, consumer-oriented type stocks, things broadening out, because those were the ones that were really impacted with their margin growth. That was a problem. And that's really important to look at because especially consumer packaged good companies, and we have PepsiCo that's going to report tomorrow as well. If you think food and beverage companies, that's a real tell on the economy, inflation. And
am I slamming Ozempic? If I'm hitting myself up with a little bit of Bonjour or whatever it's called, then.
But So price to mix and volume, the whole reason that's important, I was able to interview Tom Barkin from the Richmond Fed a couple months ago, and they're watching that metric. And Jen Bartashis over at Bloomberg Intelligence, the reason it's important is because if, like, you and I, if we're going to a grocery store or paying money, that people are spending down. And so you're seeing that in earnings reports, say the last ones we saw a couple months ago from, say, Walmart, which had strong growth, and especially in its grocery segment. But if you move over and you looked at Target, a competitor, which is now in the staples sector in the S&P 500 because of its growing grocery business, it was struggling. And so people were spending more and trading down for something like Walmart.
Yeah, so we'll see if we can kick up the volume. It's been a lot of price so far. We only have 30 seconds left with you, but this revival that we're expecting in the other 493 stocks in the index, is that enough? Is that actually going to breathe life into this broadening out trade that we've been waiting for?
Well, if you look at the NASDAQ 100 equal weight, that's actually trading at all-time highs right now. And the S&P 500 equal weight hit at record back in March, but it's only about 4% off of that all-time high. So I know people keep talking about breadth and the issues with concentration, but we've been talking about that over a year now, especially after not even just this first half, but last year's first half too. So if you're looking at the equal weight, whether it's sort of with the big tech or even just broadly with the S&P 500, you're starting to see those stocks catch up.
Jess, we thank you so much for keeping an eye on these markets. Looking forward to having you back on the show. But next, we're going to talk about the trial of the decade, really. Jurors decide Bill Hwang's fate. That and more in our Wall Street Beat next. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on the stock market right now. As it stands, the S&P 500 up about 0.3%, just 23 minutes into the U.S. trading day. The NASDAQ 100 leading the way, up 0.4%. And my favorite, we're taking a look at the Russell 2000, the small caps. To go from the big to the small, the Russell 2000 currently up about 0.4%, Sonali.
And it's time now, Katie, for the Wall Street Beat. We're going to talk about the most talked about stories in finance. First up being Bill Hwang's fate, now in the jury's hands. Remember, he's facing fraud, market manipulation, and racketeering conspiracy charges. And it's one of the most prominent white-collar prosecutions in recent years, and a very difficult one for the jury to distinguish between artificially manipulating prices and trading of stocks that he liked.
I want to just talk about the judge for about 30 seconds. The judge is 90 years old. We're talking about U.S. District Judge Alvin Hellerstein, sometimes losing his patience. He told the government at one point that, "I think you're wasting our time." And then he also told the defense that it was boring the jury to tears. This is a 7-week trial. It's obviously very complex, and this is a jury that's mostly with people from a non-financial background. So really,
he also asked, "What's a meme?" Yeah. Right? And didn't he stop the trial for a moment to show pictures of his new grandson?
He did.
Yeah.
He did, and I would say for those financial minds, this was not a boring trial at all.
It was the most exciting trial I followed in so long. The T-Live on the Bloomberg was insane.
Keep watching that T-Live, by the way. We're going to talk about another story next. Of course, that is private equity firm Clear Lake, best known for owning the Chelsea Football Club, at least $10 billion in distressed debt, prompting investors and creditors to question purchases it made at the height of the buyout boom. And of course, this story, guys, very well read on the terminal. A good reminder that private equity is not always private. Public investors own their debt.
Right. This isn't, by the way, when I read that, I thought, what, they're buying distressed debt? No, the debt that they own has become distressed.
Correct.
Right? And nonetheless, investors are still clamoring to invest in their new fund.
The reason this story is interesting, Katie, is because you have a company here that is facing a lot of troubles, a lot of the private equity industry is facing.
Yeah, and it's interesting, like, what do you do? Clear Lake, for example, uses continuation vehicles a lot compared to the rest of the industry.
Which, by the way, is selling one of your companies that you can't exit any other way to a new fund that you've raised, which seems to me to be a little bit sketchy.
It's a bit controversial, I would say.
Yeah. It's very controversial, and, you know, it's also indicative of how closed this IPO market is. Yes, we've seen IPOs nowhere near as exciting as what a lot of people would have wanted out of this market.
That's a story I think we're going to continue to talk about on Wall Street Beat. Let's get to the trading diary right now. These are the stories you need to be watching this week. Today, obviously, Fed Chair Powell delivers his semi-annual testimony on Capitol Hill for the second day. He's going to talk to Congress today after the Senate yesterday. We get wholesale inventories as well at the top of the hour. Tomorrow, we get the all-important CPI, so a really good look at inflation. On Friday, we get big banks reporting. JP Morgan, Wells Fargo, and Citi really kick off earnings season in earnest, even though tomorrow we get Pepsi and Delta. In the next hour, we're going to talk to former Fed Governor Randy Kroszner ahead of day 2 of Powell's testimony. Is he satisfied that inflation is coming down? We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And it's another day, another winning streak on Wall Street. Stocks are moving towards a 7-session winning streak, and that is the longest since November.
And Powell may power the rally even further. The Fed chair returns to Capitol Hill for day 2 of his testimony.
And risks remain to that rally Sonali was talking about as investors brace for key inflation data and the start of earnings season. Of course, we get the big banks coming up on Friday. Before that, we get Pepsi. But before we get there, let's take a check of these markets right now because it's another green day on Wall Street. The S&P 500 up about 0.3%. This would be a 37th record for the S&P 500 so far this year. The NASDAQ 100 too, up about 0.4%. This is still a tech-led rally. Meanwhile, the bond market pretty quiet right now. You take a look at where 10-year yields are, just below 4.3%, pretty much unchanged on the day, Matt.
Getting wholesale inventories as well, as the British may say. Type EcoGo on the Bloomberg terminal to see all of the economic data you need to trade on. You can see that wholesale inventories came in as expected, up 0.6%. Of course, more important for the economy or for traders worried about the economy is Fed Chair Jerome Powell's testimony today. He goes in front of the House Financial Services Committee. Here with a preview and highlights from yesterday's hearing is Randy Kroszner, University of Chicago Booth School professor and economics and also a former Fed governor. No big deal. Randy, thanks so much for joining us. Let me get your take on yesterday first. It seemed to me the important issues were Powell saying that he's satisfied with inflation coming down, but also the labor market is softening.
Yeah, I think it's coming down broadly consistent with what the Fed is hoping for. The kind of miracle of the immaculate disinflation, that we don't get a significant slowing of the labor market, but we get a significant reduction in inflation. And obviously, he was taking some credit for that, not too much, not saying that the job is done. He's saying that some of the heat is coming out of the labor market. It's still strong, but not overheated. But it's very clear, I think, both from the minutes and from his testimony, that the thing that the Fed is now focusing on is there going to be weakness? So the unemployment rate ticked up, although it ticked up kind of for good reasons because there were more people in the labor market, and so that helps to bring some of the heat out of the labor market. That is, it helps to bring the wage growth rate down just a little bit, as we saw from the most recent labor market report, and so it's sort of on course for them to be able to feel comfortable to start cutting in the fall.
It's interesting, Randy, because we're at this point where we are clearly at the more precarious parts of the tightrope that the Fed is walking here. And the longer the Fed waits, how much do you think we get into a position that the economy does start to weaken materially?
And so it is exactly that tightrope that you're talking about, because they want to make sure inflation comes down enough and that they're convinced that it comes down and not going to pop back up. Because there's the ghost of what happened in the late 70s, early 1980s, when the Fed said all clear, reduced interest rates, and then inflation exploded and they had to bring interest rates to double-digit levels. They don't want to do that. So if they are going to err, they're going to err on the side of keeping rates high for maybe a little bit longer than than would be perfect, but the crystal ball is always cloudy. It's always hard to know. And I think they're going to make sure that inflation is coming down before they start to cut. But that means that I think that raises the likelihood of a substantial slowing in the economy and a substantial increase in the unemployment rate.
Right. Well, that's what I wanted to ask you about, whether that is the appropriate track to take here. Because if you take a look at what Powell said yesterday, he said that easing too soon, too much, it could harm inflation progress, but that easing too little, too late could unduly weaken the economy. So it sounds like, again, he's very aware of that tightrope. If you were in the chair right now, what would you do?
So I think, I mean, this is a tough call, but I think what they're doing is reasonable, because the cost of inflation expectations becoming unanchored, that people say, oh, they got it wrong in the beginning, but they've kind of gotten it back, and so inflation expectations have stayed pretty well anchored. But if they make another mistake and on the same side and say, oh yeah, inflation's down, and inflation starts to tick back up, it's going to be super costly. And if you look back to the early 1980s, the unemployment rate was over 10%. It was one of the sharpest and deepest recessions we've had. They want to avoid that. So even if the economy slows a bit, I think that's a reasonable trade-off to make, to wait a little bit longer to make sure that we really do see inflation coming down and that the heat is out of the labor market.
Randy, if I pull up FCON Go on the Bloomberg terminal, FCON Go, I see that financial conditions are really loose, and I feel like the Fed wants to be restrictive right now. Why do I see that divergence? How do I square that circle?
And so I think that's exactly right, that the things aren't especially tight. Now, they don't want them to be too tight, because, of course, that would mean that it would be very difficult to invest. People would become very pessimistic and not consume. But the markets obviously are quite exuberant. The people are very positive about the prospects for the economy going forward. In my personal view, I think they're a little bit too optimistic, because real interest rates, that is the inflation-adjusted interest rate, has only become positive over roughly the last year or so. And with the classic long and variable lags of monetary policy, it takes a year or so for that to start to have an impact. And so that's why I think in the latter half of the year, we're going to start to see a bit of a slowdown in investment. Real wages are growing, which is great for households, but it's going to make it a little bit less attractive to hire people when real wage growth was negative, when it was really cheap to hire people relative to the price that you could get. So I see so I'm not quite as exuberant, but I don't think a crash is coming, but I do think that things will slow down substantially.
Well, let's talk a little bit more about financial conditions. When the Fed says financial conditions and talks about the movement there, should we really just be looking at real rates? Because these market-based measures that we keep an eye on, again, as Matt said, they show very loose financial conditions, but it seems like we're really just talking about real rates.
So that's what I focus on more. I mean, I don't think the Fed ignores those other measures, but I do think when they think about restrictiveness, one of the key things they think about is where are interest rates relative to the inflation rate. And obviously, even as they were raising rates fairly rapidly over the last couple of years, the inflation rate was generally above that. So the real rate, the inflation-adjusted rate, was negative. That's still a great time to borrow. That's not at all restrictive. It's really only become restrictive over the last year or so, which is really the first time in almost 20 years that real interest rates have been substantially positive. And that's why I think that there is going to be a bit of a slowdown. But I think that's why the Fed needs to wait, or is reasonable to wait a little bit to make sure that they are going to see the heat come out, that inflation really is coming down. But of course, that means that there's some risks to the downside there.
When you talk about risks as well and the ghost of the 70s, as you had been talking about, the other issue here is the election season and a lot of worries about how different candidates would approach the economy here and what potential inflationary forces could be underneath the surface. Fiscal spending, tariffs proposed by the Trump campaign. How do you think that complicates the Fed's equation? If they cut in September, do they risk cutting too soon just because the picture will be completely different moving into 2025?
Well, it seems like the one thing that the Republicans and Democrats agree on is to spend. So I think there hasn't been a lot of fiscal discipline over the last number of years, not just over the last few years. And I think that's going to be an intermediate to long-run challenge for the economy for sure. And the Fed is acutely aware of that. The tariff issue is one that's a little more challenging because the key is that a one-off, or is that going to be something that will lead to higher inflation? So if it's a one-off, the Fed can deal with that. If it's something that's, and we'll be able to work through that, if it's something that's going to be increasing tariffs, changes in cost structures more broadly that will lead to an ongoing increase in prices, then that's something the Fed has to really deal with. I don't think that they're assuming that it's going to be that more difficult situation yet, but they are certainly thinking about that.
Both parties definitely going to spend. Both parties are putting up protectionist tariffs on China. The one place that they really differ, Randy, is immigration, right? Under Biden, we've had an absolute flood of immigrants coming into this country, which is great for the labor market. It supplies a lot of demand. And Mckee Bowman, in a speech a couple of weeks ago in London, was talking about if that gets restricted, and the Biden administration, now ahead of the election is trying to restrict it a little bit, but if it gets really restricted, it's going to restrict the supply of labor, and that could be inflationary as well. What's your view on, how important that is?
So we're trying to suss out how important the immigration issue is in the labor market, but it seems that most of these preliminary indicators are that it's really helped to expand the labor force, helped to take some of the heat out of the labor market, so that wage pressures aren't as high as they otherwise would be. I think certainly there'll be. I think there's a strong focus in both parties of trying to reduce immigration. We can debate whether that's a good or a bad idea, but I think that's something that both of the parties are focusing on. It's likely that the Trump administration would have a more effective approach to that, and that could certainly lead to higher wage pressures.
Well, talk to us about those higher wage pressures and what that means for the overall inflation picture. I know you've had a lot to say on this in the past. You think about the risk of inflation re-accelerating. What's the most likely fuel there? Would that be coming from wages?
So that's one of the key input costs in the entire economy, because whether you're in a services sector or whether you're in a manufacturing sector, labor costs are super important. If they start to move up very substantially, it's very hard to keep inflation tamped down unless you get a very strong shift in reduction in production and so more of a stronger recession. So or the prospects of a recession. So the labor market is really key going forward for where inflationary pressures are going to come. Obviously, there could also be other supply disruptions, because you can think of the labor market as a part of the supply side of things. Obviously, there's a lot of geopolitical tensions that could lead to other disruptions there. Unfortunately, I'm not very optimistic about everything in the world being solved, all the problems in the world being solved, and having those supply chain disruptions disappear. So I think that's another thing to be very concerned about.
Randy, the other thing here, too, if you think about the fiscal issues as we have been discussing and concerns around growth, what confidence can investors have in the longer end of the curve with all of these uncertainties?
There's always a lot of uncertainty. I think it's perhaps a bit higher now because of the geopolitical uncertainties, and also that the debt and deficits are higher in the U.S. than they have been for many, many decades. And so there is a risk that at some point the bond vigilantes come back up from their resting state and say, is this going to be too much of a burden? Are they really going to be able to pay this so easily? The benefit that the U.S. has is because of our size, the depth of our markets, and also if you look to others, it's not like everyone else in the world has fiscal rectitude and we're the only ones who are not following a very tight path. Most everyone is in that similar boat, and so when you're looking at relative risks, the U.S. still looks reasonably good.
Randy, we thank you so very much for your time. That is former Fed Governor Randy Kroszner. And coming up, we're going to hear from Fed Chair Jerome Powell as he testifies for a second day on Capitol Hill. Stick with us. We'll bring you all of that coverage next. This is Bloomberg.
Well, I'm pleased to see that inflation is declining. The latest data makes clear that housing remains the #1 driver of core. Your testimony and hearing from you, a Republican who was first nominated.
Well, the House Financial Services Committee is about to start questioning Fed Chair Jerome Powell. We'll bring you that questioning as soon as it starts. But as we drumbeat to the start, let's talk now to Michael Mckee. He is Bloomberg's chief economics and policy correspondent. as well as Liz McCormick, Bloomberg's chief correspondent for global macro markets. And Liz, I'll start with you. We, of course, heard from Jerome Powell yesterday, and I'm wondering what the bond market said about what they heard from the Fed chair and whether it was noticeably different about what they've heard in the past.
Yeah, I think, it wasn't earth shattering, but the market definitely took away, and a lot of the research and talking to folks is that, he said they're balanced on their mandates, right? So CPI and inflation, which we get tomorrow, of course, is important, but that he said several times about the labor market is cooling, but it's still in good shape. So, we have a lot of data between now and the next meeting. And I did see a lot of people, the market's been priced like 70%-ish for September, but folks who are saying they think the Fed's going to cut in December said, well, maybe September's in play, So I think that is seeming more reasonable that September may actually happen, because we know the traders have been wrong before. But I think they felt he was balanced. He was looking at both mandates, and he needs, more good data, like he said. So, but I think the market took like we're not in a bad place betting on September.
It did seem, Michael Mckee, like he admitted softening in the labor market. Obviously, we saw 200,000 jobs again for non-farm payrolls, but we do see the household survey showing unemployment ticking higher. What do you expect to hear from him on the labor market today?
I think you'll get the same message from him that unemployment is rising and the economy is clearly slowing. Unemployment at 4.1% is basically where they thought it would be at the end of this year. So we're already there. And the risk is that it continues to rise. We see growth figures slowing, consumer spending slowing. So as I mentioned earlier, you get to a point where you say, is this where we are, the correct interest rate for this economy? And if we continue to see a slowdown, which the Fed expects, then you get to a point, maybe it's September, where they say, no, well, we can start cutting interest rates because the economy needs a little less restraint. It won't be new, but the focus is on Powell because he sort of emphasized that yesterday. When we get closer to an actual move, you'll hear a lot more of the Open Market Committee members talking about that.
It's interesting, Liz. I think it's fair to say you're looking at a market fairly drunk on curve steepeners. And you did see really the curve start to steepen a bit while he was speaking yesterday and really giving up a lot of that move. How do you think traders are positioning towards tomorrow's CPI, but towards the end of this testimony as well?
Right. And, bear in mind, today we have a 10-year auction, so that's at the long end, and a 30-year tomorrow. So you usually get a little tick up in rates ahead of that. But I think you're right. Especially post the debate and some of the betting odds putting former President Trump with increasing chances, you did see the curve steepen a lot. That's come back a little, but yeah, that is still the focus. I think what's interesting, Sonali, is that you have some people saying, hey, the next leg in this steepener is really going to come when we get those cuts. Like we said, whether it's September or not. Others just keep warning of this debt and deficit, no matter who's in the administration after November, that we're going to have more deficits and the debt issuance is not going to come down and maybe by next year go higher. So I just talked to an investor this morning who said, listen, with that backdrop, I only like 7-year treasuries and in. It's not worth me taking that risk because, like you said, the steepening that may come. So I do think investors are still weary of the longer end, but thoughts that the economy may be cooling, has some saying, the best bet if we go into a recession is long-term debt. So people are balancing, do we have a little in that game in case we do have the economy turn over, but more so the fiscal side has people weary of the long end.
Well, let's talk a little bit more about this steepener, because it feels like that's been breaking hearts all year. That was supposed to be one of the easy trades of 2024, that the Fed was going to start cutting rates and that the long end was basically going to stay where it is. And then you get that beautiful steepening. It just hasn't worked. And when I hear these steepening calls, Liz, it kind of feels almost like wishful thinking.
Right, I know. We have to admit that and I've written stories on the steepener, and it just hasn't really panned out. I mean, first of all, people thought the Fed would be cutting a lot more, right? In the beginning of the year, it was kind of crazy, ahead of what the Fed thought. So the Fed really cutting a lot was supposed to help the steepening, et cetera. That didn't pan out, especially if they don't go till December. The steepener is going to struggle along. I did see some rates forecasts from some of the folks on the street that has the the 2-10 curve slightly positive by year end. So people are putting their kind of forecast to their thoughts. But yeah, it has not been an easy trade. One investor who was in it for a while said, yeah, I'm bleeding. I get it, you know, and it's what they call a negative carry trade. So it's been tough, but people keep saying, oh, it's going to work. But like you said, I don't know if it doesn't pan out by the end of the year. It might be like eventually people really bail. But for now, people think, again, look at the long end with the fiscal backdrop and the Fed. Oh, people say they have to be cutting somewhat by the end of the year. They're kind of sticking with it. But it hasn't been a favorable trade for many.
You know, Mike, if you think about the way the market has been positioning towards that September rate cut, really a lot of chips being put on the table here in swaps markets. How fragile is that view?
Oh, I think the view is gaining strength. And we might point out that Jay Powell has started, but he's reading the same testimony as yesterday. So we'll get to the Q&A when they start that. But the economy itself is telling you that it needs perhaps a little bit of a rate cut coming up. The Fed has not been worried about the timing about it. And now Powell is sort of saying, well, we can do this if everything works out. He has to stop short today because we have tomorrow. If CPI came out and it actually went up, then obviously that trade would go away and a lot of people would be more concerned about the economy. But if we get what economists think we're going to get, which is a slight drop in CPI, then the trade becomes all that much more strong. And so it's kind of on the data, which sounds like the cliche, but the Fed is putting in place a scenario. And if the data support the scenario, that's what we'll see.
Liz, how helpful is this testimony really to investors? I mean, I can understand, you know, the Senate sometimes asks smart questions, but typically they just want to make statements. At least it seemed that way yesterday. And in the House, you have a lot of people who seem to know even less about the economy and are clearly just asking questions that are used to make a point, a political point, or, you know, that were written by a staffer who actually knows what she or he is talking about. Like, what do you really gain from people who are not professionals, you know, peppering Jay Powell with political statements?
Well, I'm not going to say anything too much to what you said as far as our politicians, but I will say from the people in the market, first of all, the first day is always, like you said, more important, not just because it's in the Senate, but because we get his testimony, which tends to be exactly the same the second day, to hear his prepared remarks and what the questions are. But I think everybody's got it on their screen. They've got the top live on for Bloomberg looking at it, because you never know, Matt. Once in a while, there is a question. Like, I'm always watching, taping it, because there'll be some little nugget there. He might say something, not necessarily that it changes the market pricing on the rate cuts, because he's like Mike has said, he doesn't want to give a timing thing. But interesting nuggets on his calculus, how they're thinking about it. Like we said yesterday, all the kind of several comments on the labor market is cooling is what people kind of took together as, oh, that was interesting. So I think we're watching. And, you know, remember, regulation was big yesterday. That'll be big again. He did seem to say, like we had talked, I think, the other day, that, you know, they're going to put a new proposal. So folks thinking about the banking sector, we're looking at that. So there is important things, and there's also some fun questions that we can smile at. But
all right,
I think
Liz, it looks like the questioning is about to start, so we have to say goodbye to our own Michael McKee and Liz McCormick. Let's tune in now, where questioning of Jerome Powell on Capitol Hill is about to begin.
For the Basel III endgame, you mentioned potential changes have been made to the original Basel III endgame, that a lot of progress has been made, and that the board is very close to agreeing on the substance of those changes. But the next steps, that's really what I want to get into. Let's get through the mechanics of what happens next. If the Fed, the OCC, and the FDIC agree on the substance of whatever changes you're going to make, what happens then? Like, walk through the mechanics as you anticipated.
Okay. So we're very close to having exactly that agreement on the substance of the proposed changes pursuant to those talks. The next question then is how to proceed. And, you know, it is my view and the strong view of a number of board members that the appropriate thing to do is to take that new proposal and publish it along with the effects of the quantitative impact survey and put that out for comment again and receive comment on that, and then take some time to review those comments before finalizing the regulation. And that's a discussion we're having with the other two agencies now. We have not been able to reach agreement on a path to do that, but that's something that we think is the right way to do. That's what we've done in similar situations. There aren't that many similar situations, but when we see broad and material changes to an important regulation, we think let's go out again and give all the commenters another chance to comment.
Yeah, and that also avoids serious lawsuit risk and the risk that Congress step in and overturn this rulemaking using the Congressional Review Act. I think the other agencies here, if they're not agreeing with the Fed, they're running against the independence of the Federal Reserve here. This is not a trifling matter of policy. This is a matter of real substance for the independence of the Fed and rulemaking at the Federal Reserve, which I think we should be able to keep the independence of the Fed separate, especially in this political environment. But opening up to a new comment period, so that means you have to get consensus for the Board of Governors on the policy. You have to get the agreement of the scandal-plagued chair of the FDIC or the 5-member board of the FDIC. You have to get agreement by the acting comptroller of the currency. These people should not have real standing with the Fed on a matter of serious policy, especially with a chair of the FDIC that is being ousted by his own party as soon as they can get a replacement confirmed. It's an absurd thing that the Fed has to go to an acting comptroller of the currency and a guy who's going to be out of a job very soon at the FDIC and get agreement. But thank you for listening. That was more of to convey this. So the quantitative impact analysis, is this going to include the interplay with the stress tests, GSIB surcharge, all the other capital charges here? Will that be a part of the quantitative impact analysis?
It'll be this proposal, which does include changes to the GSIB surcharge, but does not include the stress tests.
Okay. But the goal here with the quantitative impact is to actually measure the impact of these rules as enacted, right? Based upon what is existing regulatory structures. Okay.
That's right. Yeah.
All right, so let's get into the question of balance sheet as quickly as we can. 2.5 years ago, you stated, quote, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. That's 2.5 years ago. Where are we in this question of what are ample reserves?
Well, so the balance sheet, the runoff in the portfolio is now, I think, $1.7 trillion so far. So we've made quite a lot of progress. We think we have a good ways to go, and as I mentioned, and as you just mentioned, we've now slowed the pace, really with a view to getting as far as we can without creating frictions and disruption that might cause us to prematurely stop shrinking. Going a little bit slower might actually enable us to go further. We think we have quite a ways to go. It's very hard to be precise about it. It's really a question of supply and demand, and we'll find that level with a little bit of a buffer on top of it, and that's where we'll stop.
All right, thank you for your testimony. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much. Chairman Powell, are you familiar with Project 2025?
Not really, no.
You've heard about it?
I really don't focus on these things at all. I mean,
you don't focus, but you know there's something known as a Project 2025? The reason I'm asking you is because one proposal is to get rid of the Fed's dual mandate to promote only stable prices, but also maximum employment. This is your mandate. These are mandates, right? This is what you do. Is that right?
We do serve a dual mandate, that's right.
And so if there was anything that would get rid of the mandate, what would it do to our economy? What would it do to our country?
So the question of which mandate we serve is very much a question for Congress. My own view has been that the dual mandate has served us well. This is something Congress can change and change back to a single mandate. There are
What do you do to get maximum employment? What do you do?
Well, we have one tool on the economy, and that is we raise and lower interest rates. You'll find, though, that anyway, we certainly at the Fed do believe that the dual mandate has been a good thing, and it's enabled us to. It has not stopped us from controlling inflation when that was the thing that needed to be done.
And so, while of course I understand you may not have seen, heard, or read Project 2025, are you familiar with an effort in the country to get rid of diversity and inclusion?
I see these things mentioned, but honestly, we're pretty focused on our task, which is maximum employment, price stability. We're strong supporters of diversity at the Fed, as you know.
Are you aware that I created a subcommittee on diversity and employment in this committee?
Yes, I remember that.
And do you think that getting rid of diversity and inclusion interferes with your ability to really realize the mandate of maximum employment?
I spent most of my career in the private sector, and what I observed was really successful institutions in the United States, companies, organizations generally, are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table, and people feel comfortable speaking. So that's the way we feel about it at the Fed, and that's what we've been doing and will continue to do.
And do you think it's important not only to have diversity and inclusion in the public sector, but in the private sector also?
Yes, and as I mentioned, if you look at very successful American companies, you will very often see that they're good at that. They're good at hiring, attracting, investing in, and keeping diverse talent. That's one of the things that our really good U.S. public companies do well.
Have you seen improvement during your tenure where diversity and inclusion has created opportunities for more jobs and helped to reduce the unemployment rate?
Certainly seen, I think you see over the course of my long career, a big change in diversity and inclusion. And you see that in the private sector and the public sector, and I think that's generally progress. I do.
Under the work of this committee, and the subcommittee is chaired by Ms. Beatty, she was able to gather important data about what was going on in the private sector. And what she discovered was that many of the CEOs and others welcomed the opportunity to learn more and to do better and to get assistance. And we saw improvement with diversity and inclusion. Have you seen that?
There's no question. If you talk to CEOs, they get this. If you want to attract the best talent in our country now, you need to be committed to these things.
And so I would like to compliment you on the job that you have been doing. I'd like to compliment you on keeping us informed about inflation. Not only do I welcome you here today, I look forward to working with you for years to come. I yield back. Thank you.
Thank you.
The gentleman from Arkansas, the vice chair of the full committee, Mr. Hill, is now recognized for 5 minutes.
Thank the chair. Chair Powell, thanks so much and welcome back to the committee. I want to pick up where Senator Tim Scott and Chair McHenry left off and reiterate my strong support for your comment yesterday in the Senate about the need to repropose the Basel III endgame. The Supreme Court's precedent, I think, makes clear that if a rule undergoes broad and material changes from the proposal to final rule, the public must be given a meaningful opportunity to review and comment on those changes. You generally share that view, I think. Is that right?
Yes.
And I'm looking forward to seeing the results of the quantitative impact study and the separate comment period, as well as an interagency agreement you referenced yesterday. Because of Dodd-Frank's role and the vice chair for supervision, Vice Chairman Barr's role and the Fed's role, would it be fair to say the Fed is a first among equals on proposing a rule like this? In other words, does the Fed have a supremacy position on determining whether it should be fully reproposed or not, or do you view it strictly as a collaborative basis? Just curious in your view on that.
No, I would say it's strictly collaborative, and I would say that our discussions with the FDIC, which Vice Chair Barr has actually been conducting, and the OCC, they've been very productive so far. So I want to make sure to say that we've continued to work our way through this, and I believe we will get fairly soon to a resolution of the remaining process issue.
Good. Well, let me turn from that subject to the court's recent decision to overturn the so-called Chevron doctrine. Many of us believe this was the first step to reining in decades, literally, of an unprecedented, uncontrolled growth in the administrative state. And so I think all of us on at least this side of the aisle are certainly saying to the Federal Reserve and other federal agencies in our jurisdiction that we want to reassert Article I authority over the direction that independent agencies work. Would it be fair to ask you to certify that because of this change in Chevron that the Fed would commit to promulgating new rules only if they're at the direction of an explicit congressional authorization?
So I think, first of all, we're studying that and several other decisions that have just come down in the last week or two. So I haven't got anything definitive for you on that. I think you know us to be an organization, I know us to be an organization that is strongly committed to the rule of law. Supreme Court says what the law is. We'll always do what we believe the law is.
Well, I'll submit that question maybe in more detail in writing, and maybe you'll have a chance to reflect on that. Back in February, you were on 60 Minutes, and you said the U.S. budget deficit, the national debt are unsustainable. Do you still view that the U.S. is on an unsustainable fiscal path?
I do. I think I tried to be clear that the level of the U.S. debt is not itself unsustainable, but the path that we're on is unsustainable, and I think that is not controversial.
I think many of us certainly agree with that, and we know that when the deficit's at 3 times the economic growth rate and growing, it's of concern, and it's contributed to inflation. Just 3 years ago in Jackson Hole, Wyoming, you gave a speech where you were confident that inflation was transitory, which I think we've come to realize it's not the case. This hearing is sort of a can't-miss opportunity for the Fed to demonstrate some humility on the monetary policy decisions, which some on this side of the aisle particularly think have made inflation worse. Your August 2020 Jackson Hole speech, you said the flexible average inflation targeting framework regarding 2%, that you would let it run above 2%. Was the Fed blinded by the previous 20 years of global change that was deflationary and or you were not alert enough in 2020 to be more cautious about that change in policy?
So we were certainly mindful of a long period of time in which there have been very low interest rates, but also very low inflation, suggesting that the neutral interest rate must have fallen quite substantially. That was the standard view. The thing we didn't see coming was the pandemic. It's not like everything went off the rails. It's like we had this pandemic and it really changed the way the economy is working. We had a big crisis. We did a lot of things. So the concerns that led us to those concerns that we were in a world of very low interest rates all the time.
But now wouldn't you say we're in a very opposite situation where because of reshoring and tariffs and other policies that are quite inflationary?
I would say this. Those concerns are, right now we have the policy rate in the mid fives, right? And we see the policy is restrictive, but clearly interest rates, the neutral interest rate must have moved up, at least in the short term. So I think that's the question we'll be asking ourselves in our review, which begins at the end of this year.
We look forward to that.
How much of what we did in that time period is relevant to the new world where rates appear to be higher?
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you, Chairman, and welcome, Chair Powell. It's great seeing you. Last time I saw you, we had the gracious pleasure of you visiting with me in my office, and we discussed a great variety of things. Thank you for that visit. Now, Chair Powell, this year the Fed tested 31 banks, up from 23 last year. Is that correct?
I believe that's right, yes.
And by estimating losses, revenues, expenses, and capital level under hypothetical stress scenarios. We did that, correct?
Yes.
And all 31 banks remained above their minimum common equity, TAIR, 1 capital requirements, after observing losses of nearly $685 billion. Is that correct?
Yes, that is correct.
Yeah, I wanted to get those figures out and provide you with, you may have heard this, but I want to share it with the nation because your vice chair, Barr, made this statement, and I wanted to put this in the record, his exact quote from this great achievement. He said, "Our goal of our stress test is to help ensure that we have enough capital to absorb losses in a highly stressful scenario. And this test shows that we do." I thought that was a great statement of your record. Now, let me ask you my question. It's simple. Will the 2024 Fed stress test results have an impact on how prudential regulators roll out a new and updated capital proposal?
So the two are really two different things. There's the Basel III capital proposal, and then there's the stress tests. So, and really the Basel III, as I mentioned, we've discussed, we're almost ready to put forward for further comment a revised proposal with material and broad changes to it. The stress tests are a different thing, and of course we realize we have to adapt those over time and be open to changes, and it has evolved significantly over time, but it's really a separate thing from the Basel III endgame.